Is it time to sell ULTY, or ULTY as a lot of people like to call it? We're going to cover a bunch of stuff in this video, and I hope I can help you answer that question by the end. The first thing we're going to look at is an article recently put out by a Seeking Alpha writer about ULTY and some of the dangers of this fund. We're going to action pack this video. I'm telling you right now, I'm going to cover a ton of stuff, including implied volatility, the NAV, and answer a ton of questions about ULTY that you guys have been asking consistently on all my videos. I appreciate all the questions, of course, and I hope you guys know that if you are interested in income ETFs and ETF investing, you are in the right place. So don't forget to like the video and to subscribe. You're going to be joining a community of over 25,000 income-focused investors, and I've been tracking the weekly payers for over a year now. I'm really excited to get into this video. Let's roll that intro. I think this is going to be my best ULTY video yet. Let's talk about this article. We have Behind the Curtain of ULTY, Why Yieldmax's Ultra Income May Be Capital Erosion in Disguise. It's written by Eliana Cialaba, if I'm pronouncing that right, probably not. And I will say I read some of the comments on the article and they were rough. They were not very kind to Eliana. And I am going to preface this by saying she has some degree in economics, I believe, a master's even. But that doesn't mean that you know absolutely everything. And now I'm not also claiming that I know everything. I'm learning through this process with ULTY as we've seen things change. And I'm going to talk about all of that in this video, but I'm no expert. So I'm a retail investor and I own ULTY, which is why I did a deep dive into it so I can answer some of my own questions as well as some of yours. Now I'm going to start off with the summary. ULTY's high yields are misleading as distributions are primarily return of capital, leading to progressive capital erosion for investors. We're going to address all these points for the most part. The fund's aggressive covered call strategy limits upside, offers no downside protection, and exposes investors to significant structural risks and volatility. Now, I'm going to say I have some issues with this article, and that statement being one of them, it's just wrong. It's not accurate, and we all know that. If you're a fan of ULTY, if you've watched my videos, the strategy change completely changed all of that. You can literally go to their website and see that they do offer protective puts all over the place. And that was a big part of the shift. And so we're going to talk about the shift as well, the strategy change, because there were some things I left a little bit open-ended that I want to finalize. Next, we have ULTY's high expense ratio and extreme portfolio turnover further erode value, while its sector concentration amplifies risk without true diversification. This one I don't have as much problem with. The expense ratio is extremely high. It's an extremely actively managed fund. They're buying and selling every week, if not more often. Portfolio turnover is an interesting one. It does have a cost to it, so I understand why that's included. But when you are looking for the highest implied volatility stocks to write options on, you're going to have high turnover rate. There's no way against that, right? Because they change all the time. And so I understand that. And I don't fully disagree with that point, like I stated, but it's an interesting one to make. Lastly, given these unsustainable dynamics and lack of real income, I recommend selling ULTY as the prudent course for investors. Wow. I hadn't even read that one yet. That's amazing to me that they can recommend something. Is that not financial advice? This video is not financial advice. If you think that's financial advice from Ileana, you can reach out to her. I don't know the parameters of what it takes to write a Seeking Alpha article. I genuinely don't. Maybe I should reach out to them and see if they want me to write something. That would be hilarious. But I'm not going to go too far into all of the details of this. I really just want to use it to kind of bounce ideas off of and some explanations off of. So we're going to start with the high yields are misleading as distributions are primarily return of capital. That is a very, very interesting point to make as we've seen ULTY's price increase. So we're going to cover the NAV, and I do want to also mention really early on the strategy switch that changed everything for ULTY and why it made such a big difference. The first thing I want to look at is what the initial strategy switch was. So I pulled this post, which is actually from my old YouTube video on ULTY when their strategy did change and how many things they implemented that made a big difference. I had some comments from, not some, I had a lot of comments. A lot of, I wouldn't say they're hate comments towards the fund, but they were saying, no, there's no difference. They were saying, no, it was just a change in the market. And that's what I really heavily disagreed with. And there's a reason for that. Well, we can actually track that. And I'm going to show you guys that on the drip calculator. But initially, and this guy actually who wrote the post commented, which was so funny, so cool. They added protective puts, credit call spread, flexibility to write call options on portions of the underlying, and weekly distributions. It converting to weekly is not what made this fund work. And now a lot of people were saying that. They're saying, well, it switched to weekly, got a lot more AUM, and then on top of that, the market flipped completely. Now, a green market is going to help every ETF that's not an inverse, right? They're going to do better in a green market, especially a heavily green market, with some things aside if they're investing in a depreciating asset or something like that. For the most part, I should say for the most part. But there's some key factors with this that I also want to touch on. So we're going to look at the drip calculator really quick, and I want to show you guys what I mean by how the fund switching made a massive difference for ULTY in the long term. So the strategy switch took place around this dip right here. And so this is what I want to point out. People saying that it did not change the strategy, I don't agree, because what we see is VTI. This is the total market index, tracks everything. And what we see in this period, everyone said, well, it's just a good market now. And that's true. We have a very, very good market. Also, this drip calculator goes back beyond the ULTY switch for those that are confused. Well, what we're seeing here is VTI did outperform since inception. And the reasoning behind that was because the strategy was not optimized. And I'm not saying it's optimized now, but it is better. I'm going to go on a limb. I'm going to say it's better. We're seeing better distributions. We're seeing consistency. We're seeing an overall better ETF, in my opinion. But if the strategy wasn't switched and it was just a really good market that was impacting all of a sudden ULTY being a great ETF, why was it not a great ETF when the overall market was doing well? We did see, let's see, it started trading February of 2024. There were long stints of time during 2024 where the market was good. It was really good in a lot of instances too. So that is what never clicked in my head when people were saying, oh, it wasn't a strategy switch. It was. We saw it go from underperforming in a good market to outperforming in a good market. And it's not just the underlying. It makes a big difference how they change the strategy and how they have downside protection. But there is another massive point to make. We're going to also show the drip calculator since the switch, which we're going to jump into right now. So here it is from March to current. And I believe it was actually April the strategy change took effect. But we can see here what was happening. We still saw some downside, and then boom, all of a sudden the market flipped. It was really, really good. And guess what? VTI is underperforming ULTY, which again, we had not seen that prior. In a good market before, ULTY still underperformed. And so when people were saying to me in the comments and writing, they never changed anything, they were referencing other videos about it, saying, no, nothing switched. They did switch. There's also a really good video by Investing with Alex. He talked about ULTY quite a bit, and he made a good video on it, explaining everything in his deep dive. So check him out if you guys are interested. Very, very good. I have another YouTube channel I want to showcase with this video, but we're going to get to that in a minute. But I'm very, very interested in seeing your guys' thoughts on this, because to me, that doesn't make sense to say the strategy didn't switch. So we're going to jump back in. Let's talk about the other changes to the strategy that I think made a massive difference in ULTY's performance change. Back into my old YouTube video, and if there is one takeaway from this video, I want it to be this. If you only remember one thing, ULTY's performance is going to completely depend on the strategists and the options they are deploying for the fund. And this is a really weird idea. A lot of us don't think about it in the same sense because we're stock market investors. We invest in stocks and ETFs. Some of you may be only ETFs or only stocks. But when it comes to ULTY, there is so much more dependent on the strategist than there is on overall market sentiment, how the underlyings are performing, because their job is to try and predict and understand that. It's not an easy job. I don't envy them, but that's what they're trying to do. Because using the implied volatility, using options to make money on that, the success of the fund will be directly tied to them. It's not like a normal stock. It's not like Walmart stock where you can say, oh, it's down because, we're in a little bit of a recession. People don't have as much money and yada, 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 tariffs, stuff like that. That's the main factor. This is all dependent on them. So you have to trust them. And if you do, you're fine. And from what we've seen, they've been doing really well recently, but things can also change. And that's why I don't look at almost any of the yieldmax funds as buy and hold forever style ETFs. They're income ETFs, yes, but I kind of like to swing trade them depending. Some I've held for a while, some I haven't. But the protective puts, the credit call spreads, the option writing on portions of the underlying, it all depends on what the fund managers want to do, on what the strategists want to do. That is the main factor. They can make the wrong call, and what we'll see is a decline in price because they're losing more money than they're making on certain options. And they're still paying out that dividend. So what we've seen recently, if they've been on a really good streak, they've been doing really well. The market has also been really green, which does help because the underlyings have been going up. But it's a lot to factor in on how these ETFs work. And they are complicated. People like to say it's not complicated. You have return of capital, implied volatility. It is complicated. even for me, and I make content on it multiple times a week, not on this fund, but on overall ETF investing. So it's very, very interesting how retail is kind of adopting these things. And there's so many good questions, and there's been interviews done, but some of it is still very, very foggy. And so I'm hoping to clear some of that up for you guys and for myself, as again, I am an investor in ULTY. And since I am going to be asked this, I am not selling. That is not financial advice. I'm not saying that you should buy, that you should hold, that you should sell. What I am saying is I'm not selling my position yet. I will make it known I'm not heavily invested into ULTY. I don't heavily invest my portfolio into one specific position because it's a retirement portfolio. And while I do like having fun money in a lot of the yieldmax ETFs, I don't also like having too much money in one issuer. So I hope that all makes sense. But the strategists and how they employ this, again, is going to be the determining factor on how the fund performs. They've been doing really well. I hope they continue. We also, back to this. I do want to point out, for Eliana's sake, we have not seen this in an aggressive bear market. We just haven't. We don't know if the strategists are going to perform as well, if they have better options because there's more implied volatility, if they're going to be able to predict a lot of things. It's a higher risk fund, I would say, because of the holdings, which we're going to get into. But again, all of this stuff relies on the issuers, on the fund managers, and primarily on the strategists and how they're employing these option strategies to make us money. The dividends will likely stay consistent. And if they can, that's amazing. The thing that's going to change is our NAV, our net asset value. And whether or not you agree with the term NAV erosion, all of that is a big determinant factor on the underlyings and the options they're riding on them. So some people hate the term NAV erosion. Some people don't hate it, but we hate to see it. I am one of those people. I think the term, we've seen some yieldmax employees that say they hate that term. And while I agree that maybe they didn't mean to start it, I don't know if yieldmax was the coined term for NAV erosion. I think we need to understand that these ETFs do have some downside, and they will, again, depending on all the options and how they employ them. So now what we're going to do, we're going to talk about implied volatility, and then we're going to look at the underlyings, how they've been performing in ULTY, and I'll give you my 2 cents on why I think the fund has been dropping. And again, although I am not selling, I'm not buying right now either, just because I want to continue to see how it performs, and I don't want it to become too large of a position for me. I get this question all the time. Should I retire solely on ULTY? I don't think you should ever retire solely on one fund no matter what. That's just my opinion. And I do want to give a quick shout out to Stuart, who has been messaging me on multiple platforms. Super funny. He apologized, but I love it. It's super great to communicate and talk with you guys on Blossom, on Instagram. Message me anywhere. But Stuart has been giving me a bunch of feedback on ULTY, some of his concerns, and it's really been helpful and motivating for me to make this video. So again, thank you to Stuart. I'm not going to give his last name for privacy reasons, but you know who you are. And a quick shout out to the sponsor of this video, Moomoo. If you guys don't know, I use the brokerage Moomoo for all my weekly dividend challenges. I've really been enjoying it, and the platform is simple and easy to use. Plus, they're doing a giveaway right now where you are guaranteed to win some either fractional shares or all the way up to real shares of NVIDIA, depending on how much money you invest. See below, check my link for the full details, and again, thank you to Moomoo. This is going to be a longer video, but I felt like it was kind of deserved, as we've seen some downside, we've seen some scary things in the market. But just a quick recap on implied volatility. We typically have higher implied volatility in the market overall. This is kind of a broad market look when we're in a worse market, in a bear market. And that's because we're expecting things to continue downward. If they've come back up, that's great. But overall, implied volatility is the prediction of what a fund or stock is going to do. So I like to use some examples when it comes to implied volatility. For one, right now, PLTR. PLTR is absolutely nuts. And I'm not an expert on implied volatility, so any feedback on this would be great. I'm just using Investopedia. But implied volatility on something like PLTR is nuts right now. It went from $34 to $180 at one point. I'm not sure where it's at now. That's amazing. The implied volatility is going to significantly increase as that goes up because they're not expecting it to continue that trend. You would expect it to fall back down to a normal level. And there hasn't been, there's been news and whatnot that impacts that. But it's also a really interesting thought. Someone on Reddit was commenting about implied volatility and used GameStop as a really good example. As a stock where no matter what happened, the more money was flowing into GameStop stock, the implied volatility continued to increase because all of a sudden it was 100, 1,000 times its actual evaluation, and they didn't understand what was happening because you would expect a stock that has gone up significantly 2, 3, 4, 500% to drop. You're not anticipating it to do more than that. So when it comes to the underlying for a lot of these, the implied volatility is very high. There's other factors with implied volatility, and this isn't a full implied volatility video, but I did want to showcase that. Also, when it comes to the expense ratio for ULTY, it's very high. I just want to point that out again. We are making YieldMax a lot of money by holding it. And if you don't like YieldMax, but you like ULTY, we are making them quite a bit of money. 1.4% is absolutely insane. Back into the Seeking Alpha article, there's a few things more that I do want to address because I didn't dive into it. It's not a long article, but she really does compare some interesting things, stating that ULTY is mainly positioned in high growth tech companies with low revenue predictability, high beta, and little financial visibility. That's the entire point of the fund, right? High implied volatility. If you have very predictable revenue and low beta, you're not going to get good options premiums. I don't understand. She has a master's degree. This is very interesting. And I understand showcasing this and saying it's risky and saying this is why they do it, but pretending like it's just an awful fun because they do it when it's the entire goal doesn't make a lot of sense to me. And she also says the top 10 positions represent 50% of the fund, resulting in a considerable concentration on extremely volatile names. That is the point, right? That is the point. It's in the prospectus. They're telling us these are high risk names. They have to be to make good premiums, to make the good high payments. That's the whole thing. We want high dividends. I don't understand why this is even stated on here. And please don't give a bunch of hate to the lady. There's already like 90 hate comments on here. And I also want to say, just because we're fans of ULTY, don't become a diehard ULTY fan. Don't love the fund if it's underperforming. They're not going to be loyal to us. These funds, they don't know our names. They're not loyal to us. Be loyal to yourself. And if something falls and it's not doing good, it's okay to sell. Don't have that crazy cult mentality with some of these ETFs that we've seen. I'm talking about you, MSTY lovers, and I still hold MSTY, so maybe I'm talking about me as well. But it's so interesting how she writes this entire article basing it off of this. Just doesn't make a lot of sense to me. It's like someone that doesn't understand ETFs talking about it. And I mean, the ETF grades, yeah, momentum, expenses, all of that, risk is low, dividends and liquidity high. But there's another really important factor, a question that I keep getting. I still can't believe she said to sell. I think the most prudent and reasonable position is to sell. That's wild to me. Here we go. Holding a PhD in economics from UCEMA. This also doesn't make any sense to me. Focus approaches on value companies with solid long-term potential. Why would you write something that's outside of what you actually are interested in? It's like these YouTubers that make content on things they don't actually own. They're not interested. I've seen so many people rush into the income space because it's new and it's growing. Like, yay, we're all growing. We're retail investors that like income too. Yay. They're not experts on it. They just started doing it for clicks and views. So I just want to point that out. I don't know why she even wrote this article, but I think it is really interesting. And then she says, it does not constitute financial advice. Sell, not financial advice. Okay, I'm done ragging on her. Again, don't give this lady hate, guys. Please don't, genuinely. You can go and leave a nice comment. You can give critique, or you can say seem like a very nice lady, but you're wrong about these things. That's up to you. I'm not going to tell you exactly what to do, but be nice. We're nice investors. All right. Now I want to talk about something very, very key, and that is the NAV. I've been getting a ton of questions about it, so let's dive in. So they say it right here. NAV erosion risk due to distributions. When the fund makes a distribution, the fund's NAV will typically drop by the amount of the distribution on the related ex-dividend date, which is common. We see it with dividend stocks, dividend ETFs. The repeated payment of distributions by the fund, if any, may significantly erode the fund's NAV and trading price over time. As a result, an investor may suffer significant losses to their investment. And they mean initial investment, which is why some people believe that these funds are made to have drip turned on. Some people want to have drip turned off and use it just as income, which I understand, but they say it themselves, there will be NAV. And now I do want to point something out, a question I get all the time, which is, how do these differ from stocks? People are a little bit confused, and I was confused for a long time as well, because NAV, with net asset value, is what that stands for. It's different with ETFs. So market cap is what controls a lot of the price appreciation and depreciation of stocks. People buying in, people selling out. These ETFs are not like that. The only change that happens is you end up with more money in each position when the fund's AUM goes up. So what I mean by that is we had 200 million AUM go to 3.5 billion. Well, they're not increasing the price of the ETF. ULTY has sat at between $5 and $7 that entire time, despite getting billions of dollars of inflows of money. What they did was they put that money into more options. So that way you're able to pay out the distributions that they need to everybody that's now holding a portion of the fund. So that's why everyone's saying, well, I've gotten comments saying, no, this fund's rigged, it's stupid, because if you look at the AUM growing, they're just paying you out of those people's money. And it's not true, because the AUM is not going to change the net asset value of the ETF. So I think that is really key for people to understand, and it is a bit tricky. And there's a ton of good stuff on the prospectus. I've been reading it for a long time now, and every time I read one of these, I learn more and more and more. They talk about the risks. We know these are high risk income funds. They talk all about good stuff, the put strategies, everything, the synthetic to direct. And I do think it's really interesting that we trust these strategists so much that, you know, we give them all these tools that I shouldn't say we give them. They have all these tools they can use to make us money. But again, that's what it comes down to, is how they're going to use them to make us money in the long run. Of course, market depends, implied volatility, all of these are factors, but it really does come down to these strategists. And I think people kind of still see these as stocks where you buy them and you believe the company's going to do well and the price will go up because it'll be valued at more. It's not the goal of the ETFs. The goal specifically with ULTY is for the NAV to stay the same forever for the most part, right? Because you want all of your gains to come into you as income, as distributions, as dividends. And so that is a bit of a confusing back and forth. But I myself started investing in stocks. I've moved a lot of money into ETFs now, but sometimes I still get the area between them a little bit confused. ETFs are different. Growth ETFs and income ETFs are vastly different as well. So that is a very important point that I wanted to make, and I wanted to make sure everyone understands. We are getting close to wrapping up the video. A few more key points I want to hit on. We can see these are 5 of the top 10 holdings in ULTY's portfolio currently. I'm not going to go over and name them all. You guys know some: Coinbase, Upstart. Here's their year-to-date returns. So what I want to look at is the last month and how they've been performing. Some are up, some are down, some substantially, some not as substantially. Nothing too crazy. We do see in this group, there's probably a bit more. It's probably pretty close between negative and positive, and that's fine. So why is ULTY's price dropping? Well, we're having a really big shift. And I'm going to jump into the other 5. So here's all 10 total of the highest. And we can see again with 1 month, 2 of them are really high and some are just a little bit low. So they did well all in all. What's happening though is they are shifting. And so I want to call out a really cool YouTube channel that I just became aware of it today. I had it on my original, but I never looked him up. His name is ETF Inspector, got about 3,000 subscribers, a great amount. And what he does is he goes through the positions for each contract. And it's a really interesting breakdown. He showcases the trading P&L for every day. And so I'm not going to play his video. Go watch his video if you're interested. It's very technical and it's very interesting. So he'll show you what they made, what they lost, and what you can do is track exactly what they're doing. And I think this is really important. People do this for a lot of the yieldmax ETFs on X, and it's awesome. So you can see, and he'll even showcase they made money on this trade, they lost money on this trade. And what I watched his video, what they're doing now is they're actually converting to what looks like a higher put strategy, meaning they think that the markets are going to go down. And that's very, very interesting. And what that does is it means, based off market sentiment, puts are more expensive, because if everyone thinks the market's going down, they're going to buy puts. And it's so interesting. And I'm not an options expert, but you can see he has the action here. Some are B, I believe it's just buy, BC, buy to close, sell, SS, I don't know. But there's a lot of good info on here. So check him out, ETF Inspector. So you have homework. Check out Investing with Alex and check out ETF Inspector, 2 really good channels. And I definitely will be watching more of this, and I'll probably showcase more. I'm not sure how he gets the data. I should actually ask him or find out. If you guys know, let me know. Or an ETF Inspector, if you watch my content, let me know. He probably doesn't, because he's very technical with it, and I'm a little bit more theoretical and I guess just data driven. But it's really, really interesting, and I like this stuff, and he seems to have a good idea of it as well. So check him out. And as always, I appreciate you guys so much for watching this video. It's been a blast. ULTY has been the fund of 2025. I know we have msty diehard fans. ULTY in my head has just dethroned it as for popularity, not in AUM, not in total returns yet, but I think it has been the talk of 2025, what this fund is doing. And again, I want to go back. Do not hate on this lady. You can go read the article. I'm not going to link it. Just look it up, Seeking Alpha with the title. Don't hate on her. I do think it's a bit misleading how the article was written. Didn't talk a thing about the strategy change that completely changed the I wonder if she like researched this a long time ago and is now talking about it and didn't realize they did a big shift. But, you know, no hate to her. But always, as always, I appreciate you guys. Don't forget to like and subscribe. If you liked this video, check out these popping up on your screen right now, including my one video on 9 ETFs with 0 NAV erosion. Check those out. Let me know what you think. Like and subscribe, and I hope to see you in the next video.